The most overlooked aspect of crypto investing: taxes. Most beginners invest without understanding what they owe. Today I am using Claude AI to explain crypto taxation clearly so you know what to expect before investing a single dollar. Critical disclaimer: I am not a tax professional or financial advisor. This is educational content only. Always consult a qualified tax professional for advice specific to your situation. People invest, make gains, spend those gains, then face a tax bill they cannot pay. Understanding the basics before investing prevents this entirely. Today, using Claude to explain the fundamentals every beginner must understand. The basic principle: crypto is property. I ask Claude, explain how cryptocurrency is generally taxed. What triggers a taxable event? Crypto is treated as property rather than currency. This has enormous practical tax implications. A taxable event: anytime you dispose of cryptocurrency. Selling crypto for cash: taxable event. Trading one cryptocurrency for another: taxable event in most jurisdictions. Using crypto to purchase goods or services: taxable event. Receiving crypto as payment: taxable as income in most jurisdictions. What is generally not a taxable event: buying with cash and simply holding. Holding does not trigger tax, only disposing of it does. Capital gains. Explained simply. I ask Claude, explain capital gains tax in the context of crypto for a complete beginner. Include short-term versus long-term distinctions with real examples. Capital gain: the profit from selling any asset for more than you paid. You buy Bitcoin at $30,000, sell at $45,000. Your capital gain: $15,000. Tax is owed on the $15,000 gain only, not on the full $45,000. Short-term capital gains: assets held under 1 year. In many countries, taxed at ordinary income rates, potentially the highest bracket. Long-term capital gains: assets held over 1 year. In many countries, taxed at preferential lower rates. In the U.S., for example, short-term gains potentially taxed at up to 37%. Record-keeping essentials. I ask Claude, what record should someone keep from the moment they start investing in crypto to accurately report taxes? Claude's essential framework: for every transaction record, date of transaction, exact amount of crypto bought or sold, price at the exact time of transaction in your local currency, fees paid to the exchange, which exchange or wallet was used. This information allows you to calculate your cost basis, what you paid per unit. Cost basis is essential for accurately calculating gains and losses. I ask Claude to build a crypto transaction log template in Notion. The template automatically captures every required field, updated immediately after every single transaction without exception. The 5 most common mistakes. Mistake 1: not reporting at all. The assumption that crypto transactions are anonymous and untraceable. Non-reporting can result in penalties, interest charges, and in serious cases, criminal prosecution. Mistake 2: not reporting crypto-to-crypto trades. Trading Bitcoin for Ethereum is a taxable event in most jurisdictions, even with no cash involved. Mistake 3: spending gains before the tax bill arrives. If you made significant gains and spent them, you may face a bill with zero cash to pay it. Mistake 4: poor or no record keeping. Without complete records, the cost basis calculation becomes difficult or impossible. Mistake 5: assuming your country follows U.S.-focused content you read online. Most crypto tax content online is U.S.-centric. Rules vary enormously by jurisdiction. Always research your specific country's rules, ideally with a qualified local professional. Crypto taxes, what every beginner needs to know before investing. Crypto is taxed as property in most jurisdictions, not as currency. Taxable events triggered by selling, trading between cryptos, spending, and receiving crypto. Long-term holding frequently receives preferential lower tax rates. Record every transaction from day one, cost basis, date, amount, all fees. Consult a qualified tax professional in your jurisdiction before investing significantly. Understanding taxes is a fundamental part of investing responsibly. Claude is free at Claude.ai. All links in the description. Subscribe for daily honest finance and AI content. See you next time.